Good morning to everyone, and thank you very much for joining. This is the DAX Open with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address, r@fxcm.com. Today is Monday, the 21st of February, 2022. It's nice to be back. I have been off for 2 weeks, and nice to be back. Did an exam on Friday, and it went hopefully very well. And now we are back to our DAX Open. I'm just going to bring up the high risk investment warning. I want to keep this on screen for a few moments, and then I'll bring up the commentaries disclaimer, and then we'll do some analysis. Good morning, Alec. Yes, it's awesome to be back. Thank you very much. All right, here's our market commentaries disclaimer. Let's just keep this on screen for a few moments. And references market scope 2.0. So I'll just pop that up. So here's the weekly of our DAX. But before we do that, I'd like to go through the CNBC morning note, and let's see if we get any insight. Thanks. Just some nice messages coming through. So thanks, Jan. Thanks, and hopefully I did enough to get over the line. All right, let's just see here. The CNBC morning article headline reads as follows: European stocks set to climb as hopes of Russia-Ukraine solution emerge. And the article reads as follows: European markets are set to climb on Monday as hopes emerge for a diplomatic solution to Russia-Ukraine tensions. US President Joe Biden has accepted in principle a meeting with Russian President Vladimir Putin, paving the way for last-ditch diplomatic efforts to avert an invasion of Ukraine by Russian forces. White House Press Secretary Jen Psaki said Sunday evening that if Moscow does not launch an invasion in the coming days, the summit would take place following a scheduled meeting between US Secretary of State Antony Blinken and Russian Foreign Minister Sergei Lavrov later this week. Shares in Asia Pacific were mixed on Monday as investors continue to monitor the situation surrounding Ukraine, while China left its benchmark lending rate unchanged. Markets in the US are closed Monday for the President Day holiday, so just be aware of that in terms of liquidity disruptions. And that was having dropped sharply on Friday as global markets were roiled by rising tensions in Eastern Europe. In corporate news, Credit Suisse said on Sunday that it strongly rejects allegations published following a coordinated global media investigation into a mass leak of its client data over previous decades. The leaked information was purported to contain human rights abuses and businessmen under sanctions. The Swiss lender said the information published by the Organized Crime and Corruption Reporting Project and 46 other news organizations was based on partial, inaccurate, or selective information taken out of context. On the data front, initial flash PMI purchasing managers index readings for February are due out of France, Germany, and the Euro area, along with the UK today. All right, so let's take a look. This is these are line studies that I drew actually a few weeks back before I took the leave. So let's get out and start from the beginning. I'm going to keep the support and resistance in because the support and the resistance obviously still seems to be valid. And what we want to do here is try and assess trend. And of course, it's very, very difficult to assess because, quite frankly, we're in a range. I think that we would all concede that markets are stuck between the support round about the, let's call it the 14.8 and the 16,000 level. So, and we sort of bouncing quite consistently between these two levels. However, we are nearest the support level. So this is the question, right? Is support going to hold? Because if support doesn't hold, then we can make some inferences on peak and trough analysis. So let's just show you what I mean. The reference peak, right? The reference trough. Then the next point, which I believe is a valid lower peak, is over here. It's a very quick charting of a lower peak. It takes 1 week to make, but I think it would be considered valid because we do have a candlestick which has got a higher high, higher low. So I hope that makes sense, which gives us the lower peak. It only lasts 1 week before we drop, and I think that if we move below the support level, well, that would give us the lower trough, and that would be the beginning of a bear trend. Okay, how far the bear trend goes is, of course, the question, the million-dollar question. But in technicals, you know, we would consider the trend, the current defined trend, to be the prevalent trend. So we're at a very important support level. It needs to hold to ensure that there is no bear trend that ensues. So this is what we're going to have to be watching for this week. And how are we looking today with regards to last week? So what we'll do is we'll combine the two candles together to get some sort of market sentiment, and you'll see that the theme of uncertainty continues. Before I went on leave, I was continuously referencing uncertainty, which is not a good variable to be referencing, because in financial markets, uncertainty is by definition risk. So when you've got heightened uncertainty, you've got heightened risk. And I think that theme continues: heightened uncertainty, hence heightened risk. Now let's combine last week's candle and this week's candle, understanding that this week's candle hasn't really charted, right? The European session just about to open. Still got practically 100% of trade. Just if we don't count the futures market, we've got 100% of trade ahead of us. So let's take the high over here and the low. So what I'm doing is I'm taking a look at these two candles, and I'm seeing, well, with these two candles, where's the high, where's the low? Well, the high and the low is completely defined by last week, okay? Because this week is what we call an inside area. So far, price actions taking place inside last week's range. So the range is defined by last week's candle, right? Now, we need 4 points. We've only got 2 points here. We've got the high and the low. The other 2 points is we need the open and the close. So the open will be the open of the first candle, which is over here. You see where this is going, right? Let's bring this up. You see where it's going? Okay, so there's the opening tick. Okay, the closing tick would be where closing price is currently. Now, again, I want to make it very clear that the candle we're about to draw now, this is not a completed candle. This is liable to change, either to the upside or the downside, depending on if the market continues to be bearish or bullish. But what kind of a candle do we have there? Doji. Doji. What's a doji? Doji is uncertainty. What's uncertainty? Uncertainty is risk. So there is a environment of heightened risk. Now, let me just make this a doji so we can all see it as a Japanese candle. I'll do that. There we go. So there you can see it, right? So this is what is this is the sentiment that we're dealing with at the beginning of the week. Not a comfortable position to be in at all. So and the lack of trend is a bugbear, because of course, without this primary trend, Well, we've just been meandering sideways, and of course the geopolitical tensions have been playing havoc with it as well. But the idea here is we have had no real strength by the bulls to push out, and the bears are trying as hard as they can, but they haven't quite mustered the support yet. But we've got a support level here. We can sort of see some support coming in here, not quite at the level, but definitely here's the second one, third one, fourth one, fifth one. So this 14,700 level is 14,800 level. That is a very important level. The market is certainly keeping its eye on that level. So that's where we are at the moment. Let's go down to the daily, and you can see that let's clear this all out. All right, so we just left with this. So you can see that the price action over here. So this is the daily. The price action over here. This is a bizarre candle, which is symptomatic of the uncertainty that we're facing. You can see that the open, okay, here's the open, right? Here's Friday's close. So there's a gap down on the open. There's a gap down on the open. And now it's gone and pushed all the way out of the bear area, and it's pushing into the neutral area. So you're getting out of zone 3, which is the lower blue, lower red, and the market is now trying desperately to push into zone 2, which would be the upper blue and lower blue, which of course would be which would be a step forward, right? Moving out of weakness into neutrality. Well, that's a step forward. That would be regarded as strength. We've got to see if the European market has the legs to push us into zone 2 off of the media reports that, well, diplomacy may be winning, which we all hope it does. But we're right at the border here between zone 2, zone 3. So how do we trade this? Okay, so before we get into the hourly chart, let's just reiterate uncertainty. Trading in an uncertain environment means that you're trading in a heightened risk. Now, there's always going to be uncertainty in the markets. You can't get rid of that, but there is heightened uncertainty. How do we know there's heightened uncertainty? Well, we've just combined two candles and can see that the sentiment is extremely uncertain. Not only that, we can see that we've jumped a massive jump from a gap down all the way to the border of zone 3, zone 2. So it does look like there is some bearish sentiment coming in, albeit in a huge environment of uncertainty. And with that, we'll go down to our hourly. And what we want to watch for here is we want to watch the bulls. Do the bulls have the fortitude to continue with their push from the zone 3 into zone 2? And the answer to that is, well, they might. They might indeed. Okay, here's the bullish crossover. There's the bullish crossover on our trend following indicators. Sorry, my system's just going to hang for a few moments. Cash markets just opened. So just give me one moment here. Usually it takes about 20 seconds or so. I'm going to just cancel this. I'll give it one more second. There we go. All right, good. All right, so we've got the trend following indicator here showing a bullish crossover. We've got some angle and separation. That's important. And we've got the momentum, stochastic, that's turned positive. So those are our two triggers, indicating that there is certainly a spirited bullish opening. What it really comes down to now, guys, is the staying power of the bulls, and the way that we're going to measure that is, of course, can they reach the 20? And if they, sorry, can they reach the 80? I'm begging your pardon. Can they reach the 80? And if they can reach the 80, can they maintain the 80? Now, if we're able to push into the 80 and maintain that, then I actually think the prospect of diplomacy does cause a positive shift in sentiment. So let's just keep an eye on whether the stochastic makes its way through to 80 and holds. I think that's the big deal here. It comes off the back of a support level that seems to be very well supported in terms of holding at least 5 times. Okay, counting these 3 as one. It comes off the back of a gigantic move from a gap down out of below, pushing right back towards the zone 2, and now we just want to see if the short-term traders do have the willingness to push prices upwards, and the clue lies at the 80 level. I want to also just remind everyone to get a true directional feel. Probably takes about a full hour. I mean, the market's just opened. We're 3 minutes in, right? So I don't, even though we're getting some red here, I'm not convinced that there's going to be an outright bullish sell down, but we can't discount that, of course. But if we drop below the central pivot and the EMAs turn south and the stochastic roll south, well, then of course the bearish sentiment is building. But after this full hour, if we still have the EMAs pointing northeast, if we still have the stochastic moving that northeast, then it becomes very interesting indeed. One last point before we sign out. Because of the intense uncertainty, there's really no discussion around stop losses and money management. If someone wants to implement a trade based on the short-term charts, based on the possibility that there is a diplomatic solution, you must have a stop loss and you must have risk management. Is just we're in a hugely uncertain environment, and the reason is if diplomacy fails, it could happen sort of in a finger snap. The markets will react in a finger snap. If you don't have your stop losses in, if you don't have your money management set, you'll be on the wrong side very, very quickly, and it could gap. By the time your stop gets filled, there could be a huge amount of pips that have already been foregone. So just bear that in mind. All right. I was just asking if we can take a look at Bitcoin. Yeah, we certainly can. Just before we look at Bitcoin, if there's a gap down and before your stop gets hit, that's called slippage. Okay, so there's a real risk of slippage here. So let's just take a look at Bitcoin. I don't have it in this list. Let me just bring it in. Okay. All right, so just a similar type of analysis. So going from the top down, so we started the weekly, right? Okay, so put in the peaks and troughs. All right, so you've got if I'm reading this right, this would be the lower peak because this is the high low higher high off of this, which of course then the question comes in, well, is this the next lower peak here? So you want to just keep an eye on that. This is already a bearish. This is already a bearish reference candle, and this over here is very serious. So assuming we have a bear, a bear trend here. Okay, so assuming we have a bear trend here, then this over here is what we call a dead cat bounce. Okay, why is it called a dead cat bounce? Because dead cats don't bounce, right? Because they don't bounce very high. So we've got this kind of bear market rally here. We've got this dead cat bounce. This is a bearish reference candle. Here's condition 1 the highest high, condition 2, 3 over there. Well, this then could be the. Okay. Now, what's the problem with a dead cat bounce? Well, that's where the damage is done. That's where the damage is done in these bear market rallies. In that these get this is built all on hope. These dead cat bounces. In that it pulls people in that think they're getting a bargain, but if you get pulled in and this is still a bear market, well, that's where the damage gets done. How do we counter the dead cat bounce? Sorry, let me just. How do we counter the dead cat bounce? Well, we'd need to get this. We need to get this. Okay, so the bulls would need to watch for this type of a thing. Okay, then we've got the higher trough followed by the higher peak. So we're in a precarious position. Whether we get the higher trough now or not is the question. So let's watch this, Howard. But at the moment, this looks to be a suckers rally. So just be very, very cognizant of that. This will be the contra to the suckers rally. So we need to watch this very, very carefully. All right. I hope that helps. I think what we'll do then is we'll conclude at this point. Because of the public holiday in the US, we won't have a US Open this afternoon. Yeah, so let's just keep an eye on it. I'll just certainly keep an eye on it. This is a potentially very dangerous situation here. But of course, what we need to watch for, just to give the counter argument, is this. That's the counter. So if we get something like that, all of a sudden it's changed from a potential sort of suckers rally into something which is value inclined, So we're just going to watch this. Let's just keep an eye on it. We'll see how it develops throughout the week. All right, guys. Thank you very much for joining, and speak to you again same time tomorrow. Thanks very much, guys. Yeah. So it should take out the lower peak. We needed to take out the lower peak. Then we've got the higher trough, and then it becomes a higher peak. See, so if it does that, it would be like this. It would be HT. So in other words, this trough would be higher than that trough. and HP, right? So that peak would be higher than that peak. That would be then bullish. Okay, so this is kind of so, but let's just see if this is the trajectory that it follows. We'll put a question mark here on it. Okay, cool guys. Speak to you later in the day. Speak to you tomorrow morning. Thanks very much for joining, and looking forward to speaking with you this week.